I have a riddle for you.
Okay.
And I want you to really genuinely think about the mechanics of this before you try to answer.
No pressure then.
What does a $1.3 billion state-of-the-art automated pork processing plant in the middle of the United States have in common with a 500-year-old Italian gunmaker?
Wow. Okay. A pork plant and a gun maker.
And not just any gunmaker, a 500-year-old one.
On the surface, absolutely nothing. I mean, one is industrial food production. We're talking bacon, ham, sausages, high-volume, low-margin stuff, really.
Right.
And the other is heritage firearms, Beretta, I'm assuming.
You got it.
They operate in completely different sectors, on different continents, under, totally different regulatory environments. It feels like a category error just to compare them.
Exactly. It sounds like the setup to a very strange, very disjointed joke. But if you look at the source material we are covering today...
Which is fantastic, by the way.
Oh, it's incredible. Specifically, the second-order oracle section of the report. These two things are actually pointing in the exact same strategic direction.
Okay, now I'm intrigued.
They are distinct data points on a graph that are plotting a very specific curve. They are both signaling these massive, under-the-radar investment opportunities that most people are completely missing.
Why are they missing them?
Because they are too busy staring at the S&P 500 or getting lost in the latest, tech headlines.
And that is precisely why we are here. Today we are doing a deep dive into Manal P's market intelligence.
Let's do it.
And I think it is important to clarify right off the bat, this isn't your standard stock-picking newsletter where someone tells you to buy the dip or chases the latest meme stock.
No, definitely not. Reading this material felt less like reading a financial report from a bank and more like, I don't know, reading a dossier from a private intelligence agency.
It does have that feel, doesn't it?
The tagline is forensic analysis, multi-INT strategy, and deep science. Feels heavy. It feels dense. It feels like you need a clearance to read it.
It is heavy. And that term, multi-INT, is actually intelligence community jargon for multi-intelligence.
Okay, break it down.
In the spy world, the CIA, the NSA, MI6, it means combining signals intelligence, which is intercepted communications.
Right. Emails, phone calls.
Exactly. With human intelligence, which is spies on the ground, and open source data. The idea is that no single source tells the whole truth.
Mm-hmm.
But if you overlay them, if you synthesize them, you build a picture of the world that others just can't see. Mehta isn't just looking at earnings per share. He's looking at the invisible strings connecting global events.
He calls it the global machine.
The global machine.
I love that concept. So our mission today is to pull back the curtain on that machine. We aren't just going to talk about stock tickers. We're going to look at why the world is moving the way it is.
A lot of ground to cover.
A lot. And we're going to get into the weeds.
We have to. And the themes we are covering today are pretty staggering. We're talking about a massive macro shift, where copper is effectively eating oil's lunch.
A total regime change in commodities.
A complete one. We're also going to discuss the AI reality check, why the software party might be over, and why hardware is, well, the new king.
And we have a controversial one in the mix, too, the anti-woke money.
Yeah, that's a delicate one.
We're seeing what the report calls an ESG capitulation. We need to navigate that carefully, but the financial implications are undeniable, regardless of where you stand politically.
It's a fascinating trend regarding where capital is actually flowing versus where press releases say it's flowing.
That's a great way to put it.
And finally, we'll get to the stuff that sounds like straight science fiction, but is actually happening in labs right now. We're talking kung fu robots.
The videos are insane.
Reverse aging the brain and living bioreactors that could end chronic pain.
It's a lot to unpack, so let's dive right into the macro picture. The first big thesis in this report is bold.
Extremely bold.
It's called the Copper Superiority Complex.
It's a great title, and the claim is even bigger. The report argues that the market is finally waking up to the reality that copper is the new strategic commodity.
Okay.
And the long term, it is arguably becoming more important than oil.
More important than oil. That is a huge statement.
It's a paradigm shift.
We've lived in a petrodollar world for decades. I mean, the entire geopolitical map of the 20th century was drawn around oil fields. Wars were fought over it.
Absolutely. But look at the drivers here. The report calls it a structural demand shock. It's not just one thing. It's two massive secular tailwinds colliding at the same time.
Two tailwinds? What are they?
Okay, on one side you have the AI build-out. Everyone talks about the chips, the NVIDIA H100s. But people forget that data centers are physical buildings.
Right, they're not just in the cloud.
Not at all. They are incredibly power hungry, and they need massive, and I mean massive amounts of wiring, transformers, grid connections, internal circuitry. It's all copper. You cannot have a digital cloud without a physical wire.
The internet isn't magic. It's electricity moving through copper. And what's the other tailwind?
The energy transition. This is the big one.
EVs, the grid.
All of it. Electric vehicles, grid modernization, wind farms, solar farms. An electric vehicle requires multiples more copper, sometimes 3 to 4 times as much, as the internal combustion engine vehicle it replaces.
3 to 4 times. Where does all that extra copper go?
It's everywhere. The windings in the electric motor are pure copper. The battery interconnects, the high voltage harness running through the car, it adds up fast.
And that's just the car itself.
That's just the car. Then you've got the charging infrastructure. The wind turbines need huge amounts of copper cabling to get the power from offshore to the shore. The grid itself needs to be upgraded to handle all this new intermittent load, and the miners are simply completely ill-equipped to meet this demand.
So the supply side is the problem.
The supply side is a looming crisis.
The report points to a really specific piece of evidence for this, a canary in the coal mine. Or, I guess, a canary in the copper mine. It's BHP.
Yes, BHP. The world's largest miner. A massive Australian entity. Historically, when you thought of BHP, you thought of iron ore. That was their cash cow, what they were famous for.
Right, for steel production in China.
Exactly. But their latest earnings report dropped a bombshell that a lot of generalist investors might have just glossed over.
What was it?
For the first time ever, copper is their largest profit driver. It accounted for 51% of their underlying EBITDA.
51%. Let's just pause on that acronym for a second for the listeners who might not be finance pros. EBITDA.
Yeah, sure. It's earnings before interest, taxes, depreciation, and amortization.
In simple terms.
It's basically a measure of a company's core operational profitability before the accountants get involved with tax structures and debt payments. It's the raw cash generation of the business.
So 51% of BHP's raw cash generation came from copper. They are basically a copper company now that happens to do a little bit of iron ore and coal on the side.
That's it. That is a fundamental identity shift for a company of that size.
It's like if Coca-Cola suddenly made most of its money from bottled water.
It's a perfect analogy. The CEO even called it a milestone. And what's critical here is that this isn't just a cyclical upturn.
Okay, explain that distinction.
Usually commodities go up and down. With the business cycle, economy booms, you need more metal. Economy busts, you need less. This is different. The report calls this a fundamental re-rating.
A re-rating.
The role of the metal in the global economy has changed because the intensity of its use per dollar of GDP is skyrocketing. We just need more of it to generate economic growth now.
So if I'm a listener trying to figure out what this means for my portfolio, what is the takeaway? Where is the money going?
The report suggests capital is rotating. It's leaving what Mehta calls frothy software, those high-valuation tech stocks that don't make much money yet.
The ones that promise to change the world but are still burning cash.
Precisely. And that money is moving into tangible assets. We are seeing this in the material sector. The ETF for that is XLB, which is up significantly year to date. But the really interesting angle is the M&A activity.
Mergers and acquisitions. Because if you can't dig it out of the ground fast enough,
You have to buy it from someone who already has it. The majors are staring down a reserve replacement crisis. We saw this play out in the oil patch years ago.
so they're running out of copper in their existing mines.
Their existing mines are getting older, the ore grades are declining, and opening a new copper mine, a greenfield project, takes 10 to 15 years.
A decade and a half. Why so long?
Permitting, environmental impact studies, community engagement, and then the actual construction. It's a monumental undertaking. And these companies don't have 15 years. The demand from AI and EVs is here now.
So organic growth, just digging new holes, isn't a viable option for meeting the immediate supply gap?
Exactly. So they have to buy brownfield assets mines that already exist, or, more likely, entire companies that own those mines. The report mentions BHP's failed bid for Anglo American.
Right. That was a massive story. A huge deal that fell apart.
That was a transparent lunge for Anglo's world-class copper assets in South America. And even though BHP's CEO is playing it cool now, saying there's no burning need for deals, the math says otherwise.
He has to say that for negotiating leverage.
Of course. But they need to buy their rivals to survive and grow. It's a food chain, and the big fish are getting hungry.
And that connects to names like Freeport-McMoRan, right? The report mentions them specifically.
It does. The idea is to look for a consolidation premium.
A consolidation premium.
If the big fish need to eat, the medium-sized fish with high-quality assets become very, very valuable. Freeport-McMoRan, ticker SCX, is one of those high-quality, unhedged copper producers.
You said unhedged. Explain that. What does it mean to be unhedged in this context?
Many miners sell their future production at a fixed price. It's called hedging. It protects them if prices drop. It's like buying insurance.
Okay, so it locks in a profit.
Right, but it also caps your upside. If you think the price of copper is going to the moon, you don't want to be locked into today's price. You want to ride that wave.
And Freeport is riding the wave.
Freeport is largely unhedged, meaning if copper prices spike, their profits spike immediately. They capture the full upside, which makes them an even more attractive takeover target for a company like BHP that wants that pure play exposure.
Okay, so copper is the new oil. It's the physical constraint on the future. But let's pivot to the thing driving a lot of that copper demand, AI. But wait. The report calls this section the AI shakeout. It says the euphoria phase is over. That sounds ominous given how much money has poured into AI stocks.
It's a reality check. It's the morning after the big party. For the last year or so, the narrative has been that AI is this magical software tool that will make every software company infinitely profitable.
Right, just slap AI on your product and your stock goes up 20%.
That was the playbook. But the report argues we are shifting from hype to hardware reality.
So AI isn't just a cloud, it's a physical beast with an appetite.
Precisely.
Yeah.
And it's a very hungry beast. And we are starting to see the losers of this new reality. The report uses some pretty stark language. It calls it software Armageddon.
Yikes, Armageddon. Who is getting hit? Who are the casualties?
Well, a great leading indicator is the private equity world. These guys are arguably the smartest money in the room. They get to see the books before anyone else.
True.
Apex Partners had a deal lined up to take over a company called Pinewood Technologies for about £575 million. It was pretty much a done deal. Then suddenly they walked away.
Why? Did they find some accounting fraud or something?
No, nothing like that. They explicitly cited investor fears about AI's impact on the software business model as the reason for pulling the plug.
Wow, so the risk of AI made them kill a $500 million deal.
Exactly. Think about it. Pinewood makes software for car dealers. It's a classic size, or software as a service model. The dealer pays a monthly fee for the interface. But if an AI agent can just do the work, manage the inventory, schedule the service, talk to the customer, without needing a complex, expensive software interface, what happens to Pinewood's value?
The software becomes redundant, the AI speaks directly to the database, the middleman interface just disappears.
Exactly. The moat that software companies thought they had, their user interface, their proprietary workflow, might just evaporate overnight. That is a massive existential risk that wasn't priced into these stocks 6 months ago.
And it's not just pure software companies, right? The report highlights logistics. Stocks like C.H. Robinson.
Right. C.H. Robinson, ticker CHRW, is a freight broker. They're a middleman. They match truckers with companies that need to ship cargo.
And historically, that required a lot of people.
An army of people on phones and computers, negotiating rates, finding available drivers, tracking shipments. The stock has been selling off because the fear is that AI-driven productivity gains will make their headcount, their human brokers and coordinators obsolete.
If an AI can match freight 100 times faster for basically zero marginal cost,
their entire business model, their margins, they just collapse.
So if the losers are the people and the software that can be replaced by AI, who are the winners?
It comes back to our first theme. It's the picks and shovels. But specifically, hardware. The cost of intelligence is showing up in the hardware bill.
Give me an example.
Cisco, a bellwether for the whole tech industry, gave a warning about rising memory chip prices.
Okay.
And that sent a shockwave through the whole Stackdell, HPE, Arista, all the companies that build the servers and the networking gear.
Because if memory gets more expensive, their margins get squeezed. Is that the worry?
That's one interpretation, the negative one. But the report flips it. It says this signals that demand is so incredibly high that the hardware providers have pricing power.
Ah, so it's a sign of strength, not weakness.
Exactly. The component makers are seeing massive inelastic demand. So the strategy the report suggests is what they call a barbell trade.
Okay, break that down for us. A barbell has weights on two ends and not much in the middle.
That's it. On one end of the barbell, you short the losers. These are the High multiple single product SaaS companies, the ones that do one little thing like expense management or calendar scheduling that an AI agent might be able to do next year for free.
So you're betting against them.
You bet against them. And on the other end of the barbell,
Let me guess. The tangible stuff.
you go long the tangible infrastructure. Data centers, power grids, semiconductors, and, as we discussed, copper. The things you can kick. The things that AI lives on.
Because no matter which AI model wins, ChatGPT or Claude or Gemini or something we haven't even heard of yet,
They all need electricity, they all need copper, and they all need servers in a data center.
it really reinforces that theme of tangible assets over abstract hype.
That's the core of the macro thesis.
Now, speaking of shifting narratives, let's talk about the third macro theme. This one is, well, it's a bit of a hot potato. The anti-woke money.
Yes.
Or, as the report calls it, the ESG capitulation.
This is a sensitive topic for sure, but the report tackles it from a purely financial and forensic perspective. We aren't here to debate the morality of ESG. We are looking at the flow of funds.
Just following the money.
Just following the money. And the data shows a quiet but decisive rollback of ESG, environmental, social, and governance, and DEI, diversity, equity, and inclusion initiatives across the corporate world.
And the driver here isn't just companies changing their minds, right? It's not just a mood swing in the C-suite, it's pressure.
It's a perfect storm of factors. You have activist investors, you have high interest rates, and you have a changing political landscape. The report describes it as a return to fiduciary duty over platitudes.
Ouch, platitudes.
It's sharp language. But the logic is this. When money was free, when interest rates were at 0%, companies could afford to spend millions on departments and initiatives that didn't directly generate revenue.
It was a luxury good in a way.
It was. Now that capital's expensive, shareholders want every single dollar focused on returns. The focus has narrowed back to the bottom line.
Let's look at the specific evidence provided. Goldman Sachs is mentioned.
Yes, Goldman is reportedly preparing to strip DEI factors, like race and sexual orientation, from its board selection criteria. This comes after significant pressure from conservative activist groups.
And it follows an earlier move, right?
Yeah, it does. It follows an earlier move where they dropped diversity requirements for companies they take public through an IPO.
That is a massive shift from where we were just 3 or 4 years ago. I remember when they announced that IPO diversity requirement, it was hailed as a new standard for Wall Street.
It is a complete reversal. And the report notes the political context is crucial. Federal investigations into corporate DEI programs, which were ordered by the Trump administration, are changing the risk climate for banks.
So it's gone from a PR asset to a legal risk.
That's the fear. Legal departments are looking at these programs and saying, this is no longer a shield, it's a target. It's a litigation liability.
And this trend is even more stark in the energy sector. Big oil.
Oh, absolutely. Look at Shell. A few years ago, Shell was pivoting hard to be a green energy company. They were practically apologizing for being in the oil and gas business.
I remember their ads. It was all about wind turbines and solar panels.
Exactly. Now, the current CEO is openly regretting some of those past ESG-friendly moves. Shareholders are telling these executives, in no uncertain terms, stop apologizing for your business model. We want growth, and we want you to replenish reserves.
It's a complete 180. So how does the report suggest playing this? What is the trade?
The trade is to identify companies that the report describes as having bloated ESG DEI infrastructures.
Bloated infrastructures.
The argument is that these companies are vulnerable to activists like Elliott Management or Starboard, who will come in, argue for cost cuts, and refocus the company on core operations to unlock value.
So the activist playbook is to slash these departments to boost the stock price.
That's the thesis. So you look for the companies that went the furthest into ESG, and you bet that they will either pivot hard themselves or get taken over by someone who will force them to.
And which sectors are the most likely targets?
The report points to financials and legacy industrials as the primary hunting ground for this strategy. It's a bet on a return to shareholder capitalism over stakeholder capitalism.
Okay, that covers the big macro shifts. Copper, hardware over software, and the ESG rollback. Now, I want to move to my favorite part of this deep dive.
I think I know where you're going.
The second-order oracle.
This is where we get to the whispers. These are specific, seemingly isolated events that generate what investors call alpha returns that beat the market, because most people don't connect the dots.
It's about seeing the signal in the noise.
That's it, exactly.
So let's start with the one I mentioned in the intro, the port plan. Smithfield Foods announces a $1.3 billion pork plant with advanced automation.
Right. Now, a generalist looks at that and says, okay, Smithfield is expanding. People like pork. Good for them.
Seems straightforward.
But the forensic analysis asks, why so much automation? $1.3 billion is an astronomical number for a food processing plant. Something else is going on.
It's the labor shortage. Right, that has to be it.
It's demographics.
Yeah.
It's a two-pronged problem. You have an aging workforce, people retiring, plus you have a lack of young people who are willing to do that kind of difficult, repetitive physical work.
I can't imagine it's an easy job.
It's cold, it's wet, it's hard. Smithfield isn't just building a factory. They are signaling a CapEx supercycle in food processing automation.
CapEx, meaning capital expenditures.
Big investments in machinery. They simply cannot find the humans, so they have to replace them with robots.
And that leads us to the stock pick, Rockwell Automation, ticker RAOK.
Rockwell makes the brains and the arms for these automated factories. They make the sensors, the programmable logic controllers, the software that runs the assembly line.
So Smithfield's budget is a leading indicator for Rockwell's future sales.
It's a massive leading indicator. If Smithfield is spending billions on automation, everyone else in the food industry, Tyson, JBS, Hormel, will have to follow suit just to stay competitive on cost.
It becomes an arms race, a robot arms race.
Exactly. If Smithfield's bacon is cheaper because robots made it, everyone else has to automate or die.
So Smithfield is the signal, Rockwell is the trade. Let's move to the next whisper. Port security. The shipping company Hapag-Lloyd buys Zim, an Israeli rival.
This was a big deal. $4.2 billion. But the catch, and this is where the multi-INT analysis comes in, was that they had to carve out a separate entity for Israeli trade due to a government golden share.
Explain golden share for us. I've heard that term, but I'm not totally sure what it means.
A golden share is a mechanism where a government retains a special share in a privatized company that gives them veto power over certain decisions, usually related to national security.
So they can block a sale or a change in strategy?
Correct. In this case, the Israeli government said, you can buy the company, but we keep control over the ships that serve our ports in times of crisis.
Which basically means the government views the shipping line not just as a business, but as a critical national asset, a lifeline.
Correct, and that's the broader trend. Nations are viewing their entire supply chains through a national security lens now. A port isn't just a place to unload containers of TVs and sneakers anymore.
It's a fortress. It's a choke point.
It is. If you control the port, you control the food, the fuel, the energy supply. You control the country.
So who benefits from paranoid ports? What's the trade?
The trade is Kratos Defense, ticker KTOS. They provide unmanned systems, drones, basically for port and maritime surveillance.
Eyes in the sky and on the water.
And under the water. The logic is that as port security becomes state-level critical infrastructure, governments are going to mandate hardened perimeters. You need eyes everywhere, 24/7. Companies like Kratos are going to see a surge in government contracts to provide that surveillance.
Fascinating. It's the militarization of commerce. Okay, next one. The guns. Beretta, the 500-year-old Italian company, buys 10% of Sturm Ruger, ticker RGR.
This is a classic diversification play. European defense firms are worried about military spending cycles.
What do you mean by that?
Right now, Europe is rearming because of the war in Ukraine, so business is booming for military contractors. But they know that eventually the war ends and those budgets get cut. It's a very cyclical business.
So they want a more stable revenue stream.
They want exposure to the U.S. civilian firearms market because it's massive and, frankly, very stable and predictable.
Americans love their guns. It's a consistent market.
It is. It's recession resistant. Yeah. And Beretta buying a 10% stake is a signal. It suggests that Sturm Ruger is a takeover target.
A shot across the bow, so to speak.
You could say that. RGR is undervalued as a standalone company. It has zero debt and pays a nice dividend. But as part of a global conglomerate like Beretta, it makes a lot of strategic sense. It's a hedge for Beretta against peace in Europe.
Okay, here's one from the entertainment world. America's Next Top Model and Jeffrey Epstein. What's the connection?
This is the reputation risk whisper. We are seeing a major cultural reevaluation of what the report calls the Wild West era of reality TV.
The early 2000s.
Exactly. Shows that were acceptable then, like America's Next Top Model, are being viewed as exploitative now. There are documentaries coming out, lawsuits being filed by former contestants, alleging mistreatment, trauma.
And the report mentions associations with Epstein regarding other media figures, too.
Right. It creates a liability minefield for the companies that own this content. So the trade here is to short Paramount Global, ticker PARA.
Why Paramount specifically?
They own MTV and CBS. They're sitting on a massive library of content from that era that is potentially toxic. We aren't just talking about bad PR. We are talking about advertiser boycotts and, more importantly, litigation.
That is a really interesting angle. It's not about what they are making now. It's about the skeletons in the digital closet.
Exactly. In a world of what they call social inflation, where juries are awarding massive damages for things like emotional distress, having a library full of potentially exploitative content is a balance sheet liability. It reduces the value of the asset catalog, which is usually a media company's biggest strength.
One more whisper from this section. The China pivot. China's high-speed rail is drowning in debt.
The number is just staggering. 6.4 trillion renminbi in debt. That's nearly $1 trillion.
$1 trillion on trains.
For years, China used high-speed rail construction to keep their economy moving, to hit their GDP targets. They built lines to nowhere, servicing tiny villages. The report argues that China's investment-led growth model has hit a wall. They simply cannot afford to build any more vanity passenger rail.
So if they stop building trains, where does the stimulus money go? Because the Chinese government has to spend money to keep people employed.
The theory is it has to pivot. It goes into productive infrastructure.
The difference.
Productive infrastructure is stuff that actually makes money or generates exports. Mining, agriculture, energy projects, things with a real ROI.
And the beneficiary of that pivot is?
Caterpillar, kicker CIT. If China pivots from building passenger rail to digging mines for lithium and copper or modernizing agriculture, they need excavators, not tunnel boring machines. Caterpillar sells the equipment for productive earth moving.
It's all about seeing the second-order effect. The train stops, so the excavator starts.
Precisely. That's the whole philosophy of this section.
Let's move on to segment 4. High-conviction, contrarian ideas. These are the stocks that everyone hates, which is exactly why this report loves them.
These are the deep value plays. And yeah, they are for the brave. These are stocks that look ugly on the surface, but have a hidden catalyst.
First up, MBIA. Ticker MBI.
This is what we call a binary bet. It's either going to be a huge win or a total loss.
So high risk.
Very high risk. MBIA is a bond insurer. But at this point, its stock price is almost entirely dependent on one single thing: Puerto Rico's debt restructuring. Specifically, the debt of the pre-PA power utility.
So it's a court case gamble.
100%. MBIA insured those bonds years ago. If Puerto Rico defaults, MBIA is on the hook to pay the bondholders. If the court rules favorably for the bondholders and forces Puerto Rico to pay up, MBIA is off the hook, and their stock is what they call a multi-bagger. It could go up huge.
And if the court rules against them?
If the court rules against them, or if the oversight board gets its way, it could be a wipeout for the stock. It's not an investment in a business, it's a litigation arbitrage.
High risk, high reward. Okay, what about Sangamo Therapeutics, SGMO? The report calls it a zombie stock.
The market thinks it's the walking dead. They have a terrible history. Bad financing deals, shareholder dilution, investors just hate the management. But the report argues the market is ignoring the science.
The baby in the bathwater.
That's the idea. They have a gene therapy for Fabry disease, codenamed ST920, that is supposedly best in class.
Fabry disease is a rare genetic disorder, right?
Yes, it affects the kidneys and the heart. It's a very serious condition. Current treatments are expensive and require constant infusions for life. Sangamo's clinical data suggests they might have a functional cure, a one-and-done treatment.
So the thesis is, the company is a financial mess, but the drug is gold.
Right. And in biotech, a good drug usually finds a way. The prediction is a partnership announcement. If a big pharma company like Pfizer or Merck comes in and says, we'll fund this to the finish line, the stock could double overnight because the bankruptcy risk is immediately removed.
What about something a bit more tangible? Stellantis, STLA, the car maker.
The maker of Jeep, Ram, Peugeot, Fiat, a whole bunch of brands. They are trading at a PE ratio of 4.
A PE of 4. The S&P 500 average is like, what, 25?
Exactly. A PE of 4 implies the market thinks the company's earnings are going to completely collapse. It's priced like it's going out of business.
And why is that?
Because the dominant narrative is that legacy auto is dead, that Tesla and the Chinese EV makers will eat them alive. But the report argues Stellantis has best-in-class margins. Their CEO, Carlos Tavares, is an operational genius. He is extremely disciplined on cost.
And what about their EV strategy?
They're being very pragmatic about EVs, not overspending, not chasing market share at any cost, just adapting. The report calls this growth mispriced as decay. You're buying a cash printing machine for pennies because everyone else is chasing this shiny Tesla object.
And finally in this section, Geopark, GPRK, Latin American oil and gas.
This is a classic case of a geopolitical discount. They operate primarily in Colombia and Argentina.
Okay, I see the problem.
People hear Argentina, they run for the hills because of the hyperinflation and the political instability.
Yeah.
But Geopark has assets in Vaca Muerta, a massive shale patch in Argentina that has world-class geology. It's like the Permian Basin in Texas.
So the rocks are good, even if the politics are messy.
The rocks are fantastic, and they are growing. They are on a path to triple production by 2028.
Triple production.
Tripling production. And the market is completely ignoring it because of the zip code. The report thinks that's a mistake, that the geology will ultimately trump the politics.
Okay, let's leave the stock market for a minute and look at the venture radar. This is the future tech section. And we have to start with the Kung Fu robots.
We have to. The company is Unitree Robotics. There was that viral video from the Chinese Spring Festival Gala.
I saw this. It was, what, 100 of them? A cluster of these dog-like robots doing a synchronized dance, parkour, and yes, Kung Fu movements, backflips, high kicks. It was unnerving.
It looks fun, but the implication is incredibly serious. This is about physical intelligence. For a long time, robots were clumsy. They fell over if you pushed them. Unitree is showing that the ability of a robot to move, balance, and recover in the real world is advancing much, much faster than we thought.
It connects back to that Smithfield pork plant, doesn't it?
Completely. If you have robots that can move like that, they aren't just for dancing on TV. They are for labor. If a robot has the dexterity to do a kung fu kick, it has the dexterity to slice a ham or load a truck. The disruption of manual labor is imminent.
Then there is Moonshot AI, also known as Kimi.ai. This is a Chinese AI lab.
And this is about agentic AI. We need to distinguish this from something like ChatGPT.
How is it different?
ChatGPT is a chatbot. You talk to it, it talks back. It's a passive tool. Agentic AI is an agent that does things in the world for you. You tell it, book me a flight to London for next Tuesday, and it goes to the airline website, uses your credit card, and actually books the flight.
It takes action.
It takes autonomous action. And the report says Washington is alarmed.
Why?
Because Moonshot is hosting what they call OpenClaw agents. If China controls the platform for autonomous AI agents, that is a massive national security issue. Imagine millions of AI agents interacting with the global economy, making purchases, signing contracts, all running on Chinese servers under Chinese law.
It's a parallel digital ecosystem to the West, a whole new vector for influence.
And control. And speaking of security, Quantum Systems, a German drone company. This is the defense tech challenger. The founder, Florian Seibel, was at the Munich Security Conference essentially yelling that European defense budgets are wasting money on legacy equipment destined for graveyards.
What kind of legacy equipment, like tanks?
Like heavy tanks and manned fighter jets.
Yeah.
He argues the future of warfare is autonomous drones, swarms of cheap, expendable drones. He says the old guard companies like Rheinmetall are fighting the last war.
And he's positioning his company as the alternative.
He's positioning Quantum Systems as the Anduril of Europe, the tech-first, software-defined defense prime.
Now we are going to go even deeper into the killer experiments.
My favorite part.
This section of the report is dense but incredible. It takes academic scientific papers and synthesizes them into startup ideas. This is where we see what's brewing in the labs before it hits the market.
This is the synthesis engine. It's pure creativity applied to hard science. It asks, if paper A is true and paper B is true, what revolutionary product can we build at the intersection?
Let's start with the Cancer Hunter. This involves TAPA and EVs. And to be clear, not electric vehicles.
No, extracellular vesicles. Think of them as biological FedEx. They're these little packages that cells use to send messages and proteins to other cells.
So what's the big idea here?
It addresses the biggest problem in cancer therapy, toxicity. Chemo kills the cancer, but it also kills your hair cells, your gut lining, your immune system. It's a blunt instrument.
We need specificity.
We need a sniper, not a carpet bomb. The report proposes an ND gate therapy.
Like a logic gate in a computer. If this ND that, then proceed.
Exactly. In coding, an ND gate only opens if condition A and D, condition B are met. They found a way to use graph learning to identify proximity antigens.
Okay, what are those?
These are two specific proteins, let's call them protein X and protein Y, that sit right next to each other on the surface of tumor cells.
But do they sit next to each other on healthy cells?
That's the absolute key. No, healthy cells might have protein X or they might have protein Y, but they don't have them together in that specific configuration.
So the drug only works if it sees both proteins sitting side by side.
Correct. They engineer these extracellular vesicles to bind only if both antigens are present. It has two hands, and it needs to grab both at the same time to clamp down. Then, once it's attached, it injects its payload, a special Mirnac cocktail called Mircom-15 that tells the cell to die.
So if it bumps into a healthy liver cell that only has one of the proteins, nothing happens.
It just bounces off. It's completely harmless. But if it hits the tumor with both, it engages and delivers the kill switch. It could drastically reduce toxicity and open up a multi-billion-dollar platform for treating solid tumors.
That is incredible. Okay, next one. Reversing brain aging. Myelin rekindling.
This one gives me hope. You know how our brains slow down as we age? We process information slower, our reaction times drop. A lot of that is because the myelin sheath, the fatty insulation around our nerves, degrades over time.
It's like a frayed charging cable for your phone. The signal doesn't get through as cleanly or as quickly.
That is the perfect analogy. And for a long time, the dogma in neuroscience was that once your myelin-producing cells die or stop working, that's it. It's an irreversible process.
You can't fix it.
But this new paper shows that the old cells that make myelin, they're called oligodendrocytes, aren't actually dead. They're just sleepy.
Sleepy, what do you mean?
They are dormant.
Oh.
They've gone into a senescent state. The amazing part of the experiment shows that a specific graded demyelinating stimulus, basically a very mild controlled stress signal, can actually wake them up. It rekindles them, and they start repairing the myelin just like a young, healthy brain would.
So we don't need stem cell transplants. We don't need to inject new cells into the brain. We just need to wake up the crew we already have.
Exactly. This is huge for diseases like multiple sclerosis or MS, where the body's own immune system attacks its myelin. But it's also huge for general longevity. Imagine a pill you could take at age 60 that refreshes your brain's insulation and brings your processing speed back to what it was at 25.
That would be the best-selling drug in the history of the world.
Without a doubt.
Last experiment, living bioreactors for pain.
This one is aimed squarely at the opioid crisis. Opioids work for severe pain, but they are systemic. They go everywhere in your body and brain, and they're incredibly addictive.
So we need a non-addictive, targeted alternative.
Right. The idea here uses a type of cell called satellite glial cells. These are helper cells that naturally sit wrapped around your spinal nerves.
And what do they do naturally?
They naturally control how excited your neurons get. They act like a dimmer switch, regulating the pain signal before it even gets to your brain.
Okay.
The proposal is to use gene therapy to hack these cells. You engineer them to secrete a hyperpotent natural pain blocker called fibrillin-2 directly onto the spinal nerves.
So your own body becomes the painkiller factory.
At the exact spot where the pain signal starts. It's a localized biological block. No pills, no addiction, no systemic side effects, no high. Just a one-time shot that turns your own glial cells into a permanent pain-blocking shield.
That would change the world for millions of chronic pain sufferers.
It would be revolutionary.
Okay, segment 7, global intelligence and M&A. Some quick hits on what the big players are doing.
We have to circle back to BHP.
The Copper King.
The CEO said there's no burning need for mega deals after the Anglo American bid failed. But the report says, don't believe it. The pressure is on. They validated the green metal supercycle with their own earnings. Watch for them to make another move. The market is just waiting for them to drop the hammer on another acquisition.
And Danaher buying Massimo, a $10 billion deal.
This is a very clever, multi-layered move. Danaher is a massive conglomerate in life sciences. On the surface, they want Massimo's hospital monitoring, tech pulse oximeters, and so on. But Massimo is also in a massive lawsuit against Apple over the Apple Watch sensor.
Right. Massimo claims Apple stole their tech for the blood oxygen sensor.
By buying Massimo, Danaher inherits that lawsuit. And Danaher has much, much deeper pockets than Massimo. It gives them a huge stick to beat big tech with. They don't just acquire a company, they acquire leverage.
What about UBS and Credit Suisse?
This is getting messy for UBS. Remember the shotgun wedding where the Swiss government forced UBS to buy its failing rival Credit Suisse to save the banking system?
Yes, it happened over a weekend.
Well, a Zurich court just ordered UBS to open its books on the valuation of Credit Suisse at the time of the deal. The former shareholders of Credit Suisse think they got ripped off, that UBS got it for a steal.
So they could be on the hook for more money.
If the documents show UBS underpaid, they might be on the hook for a massive payout. We're talking billions of dollars.
And finally, Macron in India.
He's there selling fighter jets. But the key here is India's strategy. They are playing multi-alignment.
Meaning they don't pick a side.
Exactly. They buy weapons from the West, like from France. They
Yeah.
buy oil from Russia. They are in security dialogues with the U.S. and Japan. They balance everyone. This deal is good for Dassault and Safran, the French defense companies, but it's really about India asserting itself as a superpower that doesn't choose between camps. They're building their own pole in the multipolar world.
Okay, let's try to synthesize all of this. Let's unpack this entire deep dive. What does it all mean? We've covered a lot of ground.
We have, from copper mines to kung fu robots to living bioreactors in the spine.
It's a journey.
And if you look at the threads, copper eating oil, hardware eating software, robots taking manual labor, and gene therapy hacking our biology, there's a disturbing but fascinating conclusion.
Go on.
The report ends with a very provocative thought. It invokes the concept of feudalism.
Feudalism, like knights and peasants and castles.
Think about the economic structure, not the costumes. AI is driving the cost of intelligence, of mental labor, to zero. If you are a coder, a writer, an accountant, AI is deflating the value of your work. At the same time, robots are driving the cost of physical labor to zero. If you are a factory worker, a warehouse picker, a truck driver, robots are deflating the value of your work.
So if you can automate thinking and you can automate doing, what is left that has any value?
The stuff you can't print. The stuff you can't simulate. The report argues it comes down to two things: the raw materials, copper, energy, land, and the biological IP. Owning the patents for the cure for aging, the cure for pain.
So we are heading back to an economy where owning the resource and owning the life extension is the only thing that matters. The rest is just a commodity.
A kind of techno-feudalism, where the new lords own the copper mines, the data centers, and the gene therapies, and the rest. The service economy, the knowledge economy, is just automated noise.
That is a heavy thought, a really heavy thought. But it explains so much of what we talked about. It explains why BHP is pivoting so hard to copper and why scientists are trying to rekindle brain cells. It explains why Smithfield is building a billion-dollar robot army.
It connects the pork plant to the gun maker. It's all about securing the tangible assets in a world that is becoming increasingly automated and abstract.
Well, on that cheerful note, I want to encourage you, the listener, to look for these second-order effects in your own newsfeed. Don't just read the headline.
Ask the next question.
Exactly. Ask yourself, if this happens, who sells the copper? Who sells the robot? Who secures the port?
That's where the alpha is. That's where the truth is.
Thanks for listening to The Deep Dive. We'll see you next time.